Let's move on to the second phase, balancing the balance sheet and handling special line items. So for the balancing, we will just have a look in a second at a slide from the introduction. For the special line items here, let me just quickly mention that these are special for two reasons. The first reason is that deficit not covered by equity and the interest expenses for the current accounts are related to the balancing and thus need our special attention. And the other reason is that income taxes are just calculated once a financial year, and that's just work a bit differently from the rest. For the bank loans, actually, well, these are not special as such, but the reason I'm covering these here is that they also incur interest expenses, and it just makes sense to cover both interest expenses from the bank loans and from the current accounts in one package. Also, let me quickly jump again to this slide so you will remember this from the introduction. In the introduction, my intention was to make this as understandable as possible, and for that it was easiest to start out with net income because it's the most natural way to think about how the balance sheet might become imbalanced. But here, for the final version of the model, it's actually easier if we go with the generalization on the right-hand side. So we will balance based on delta apostrophe net balance sheet, which considers everything but net income, and net income we will balance based on this separately in the end. So it's a two-step approach to balancing in the model. First based on delta apostrophe net balance sheet, and then net income part we will take care of in the end separately. Now to start out, however, we will first look into working capital. So we will calculate those historic KPIs, DAO, DSO, and DPO, apply optimizations to them, derive the respective balance sheet items for our plan, and then we have imbalanced the balance sheet because of this working capital optimization. So this is one source of imbalance, but there are also others from the planning. So then it's time to move on to balancing based on delta apostrophe net balance sheet and finally net income. Here we are in the Excel model, and I move to the PB tab to explain this to you. So in fact, the implementation over here on the B tab is just very much the same. The reason I want to explain it on the PB tab is in here we have some more line items because we're reading in the interface and make this adjustable. And over here in the PB tab, it's just a much more cleaner perspective on this that makes it easier to follow. In terms of the IDs, you will note that here I go with those OIDs and over here I don't. The reason for that is simply because in here, when I make these things adjustable, so for example for sales, this value is naturally potentially different from this value. So I'm having this ID kind of twice, and that's why I decided to go here with this O at the end to make it obvious which one is the eventual value that we should use further down in the model. So the first thing we have is this switch, and it turns the balancing either on or off. We do the balancing if we are in the planning horizon, and well, before January 2024 we don't want to balance, which is why we have those zeros here. So if we use these here in the multiplication, this will just naturally turn off the balancing if we are not in the planning horizon. The next thing we have is the working capital down here, that is the working capital KPIs. And here you can see the historic values that we calculated, and here the target values after optimization. When we look into the formulas, you will note that these always start with this check, making sure that we do not divide by 0. Other than that, we are just making sure that we are in the planning horizon. If we are in the planning horizon, we directly go for the target value. If we are in the actuals, we do the usual KPI calculation. So for example, DAO, we need to get the inventories and we need to divide these by the material expenses. So let me just go up. Here we have those inventories. Note that I'm doing this for finished and merchandised only, as these happen to be the only inventories around in this case. And also as a side note, this is something that's particularly relevant when you're doing this for DSO and for planning the trade receivables. If your business comes with different service lines, for example, and these happen to have different payment terms, for example, you charge quarterly or you charge monthly for some other services, then it makes sense to also plan the working capital separately, as these are just, well, like different businesses. So it makes sense to do that. Here I did this directly for this line, but this is more because the other lines are not used. And well, here we have those material expenses from up here in the balance sheet. We have the period length as usual, those 30 days. We need to multiply by -1 as material expenses are a cost item and thus come with a negative sign in the income statement. However, in the KPIs here, we want to go with positive numbers, and that's why we need this multiplication with -1. For the DSO and DPO, this just works the same, so I don't think I need to go into detail here. And this then already brings us to the planning horizon, so let's see how we use those target KPIs to plan the balance sheet items. Let's go for something else this time. Let's go for DSO. And you can see that we are using these for the trade receivables, external trade receivables, that is, because for the internal trade receivables and other intercompany relation stuff, well, we can write control this more or less. So here it makes sense to optimize the working capital primarily for the external things. So for the trade receivables, I'm just using the rearranged formula, as you will remember from the slide, if we are in the planning horizon. Other than that, if we happen to be not in the planning horizon here, I'm just getting the respective value from the beta, which happens to be the case if we are in the actuals. So that's just the value that we read in, basically. We go down here. And we do this for all the line items that are affected by this. Before we move on, let me just quickly add a couple of comments here. So first, on the meaning of these KPIs in this case. As this is a technical walkthrough, I just did some shortcut target KPIs here. So for the DIO, for example, I just took the last year's average, which turned out to be 121, and I optimized this just slightly to 120. For the DSO, it's important to remember that we are dealing with a brick and mortar retailer here, so customers pay at the point of sale, and you do not really have DSO. So I wanted to include them in the case anyway to show how this is working in the model. And I went with these 3 days here as a target value. A rationale for this could be that you are using a payment processor and they just take 3 days to process the payments or something like that. But it would have been, boring or missing if these were 0, and it's also not that realistic, so I went with these 3 here. Now for the DPO, actually, it's important to understand that when we have on average 203 in the last year and we go down to 150 now as a target value, this is not an improvement. In fact, it's making things worse for us. Because for DPO, it's just the other way around, what an improvement is and what is not. But here, if you only ever pay your suppliers as often as old-fashioned, I'm sure that will cause some problems and is also not quite realistic. So that's why I decided to decrease DPO here a bit from some 203 on average in the last year to 150 in the planning horizon. Another thing to mention is that when I plan the working capital up here on the balance sheet, so for example here for the inventories, I'm currently going for the last period's KPI to extrapolate the balance sheet item. However, I could also just try to use this one here from the period as such, and the reason for that is I'm no longer at risk of running into a circular reference, as this here is a target value, so DIO here are no longer calculated from the inventories up here, but they are just a constant that I provided, and this is why I can calculate inventories based on DIO, because DIO are no longer a function of inventories, but just a target variable. Now, when something like this happens in a project situation, it's usually best to first ask yourself, could there be a reason for this to be the way that I just modeled it? And here it turns out that, well, when you optimize these working capital KPIs, this may naturally come with a lag, so you cannot expect things to work out right at the spot. So it may just make sense to have in this first period this lag and model it just the way that it's now in the model. Other than that, as you can see here, as in the planning horizon, I'm not varying these anymore. It's really only making a difference here where we transcend from the actuals to the planning horizon. And I don't really think we need to correct this here. In this case, I would just go with this explanation that it may take some time to adapt these changes. So now we can calculate the deltas for the net working capital. So what we are doing is here, let's this time go with the trade payables. We are taking the respective value from up here from the AX column, which we are in, and we are subtracting the previous columns or months value. So for example, for the external trade payables, we would go with those 6.2 million and subtract those 5.6 million, which then gives us some 600K. We do this for all these items. And then we just sum the assets deltas up and subtract the liabilities and equity delta. So this is then this, which is our delta net working capital. So here remember 3 things. It's better if this is negative, like explained in the introduction, because then this is equivalent in terms of effect to positive net income. We are looking at deltas between periods, and we are looking at a netted value because we net things from the asset side of the balance sheet with one thing from the liabilities and equity side from the balance sheet. Now here, as I mentioned in the introduction, we will not use this, but you could if you wanted to turn this into a valuation model. So let's move down here to the balancing part. And the first thing that we need to calculate here is delta apostrophe net balance sheet. So this is what we are doing here. We are getting the assets without cash and equivalents because we will use them for the balancing, and net income balancing related items because we will take care of these separately, and we will, for the right hand side of the balance sheet, get the liabilities and equity without current accounts, as these are used in the balancing, and without net income balancing related items, as we will take care of these separately. And then we can calculate delta net balance sheet with this apostrophe down here. So those 60. For these here, this is just the same idea as I showed up here for the working capital items. So remember here we went with the value from the AX column, subtracted the value from the AW column. Same idea here, just that we happen to have much more values that we need to take into consideration. So here again, we go with these AX values, sum them up, and subtract the respective AW counterparts from the previous period. Same thing for the right-hand side of the balance sheet. And then here we can just calculate the netted value of those deltas. And this then is delta net balance sheet with this apostrophe. Now, as we want to balance based on cash and equivalents and the current accounts, we need to get their respective opening balances here. So for the cash and equivalents, these are some 726.8. And for the current accounts, these are some 2.2 million. The next thing we want to check is which case we are actually in. So remember the slide with the cases from the introduction. And here we happen to be in case 4. So the right-hand side of the balance sheet happens to be larger than the left-hand side of the balance sheet. And we have some available cash. So the available cash, that's easy. You can just see that here we have those 726.8. And the fact that delta apostrophe net balance sheet happens to be positive tells us that the right-hand side of the balance sheet is larger than the left-hand side of the balance sheet. So here to give you another example, here this happens to be negative, and then here we are in case 2, which just like case 1 happens to be just the other way around in terms of A and P. So A and P, for the left-hand side, that's easy. That's just assets or the active part. For the right-hand side, liabilities and equity. You sometimes also refer to this as the passive part of the balance sheet, and that's why I'm using this P as shorthand notation for this. Just because I want to go with a single character and I don't want to go with LE, so I'm using the P here. When we scroll down a bit, we can also see why this case 4 with P larger than A is equivalent to negative net income. So here we have the net income balancing section, and you will see here that case 4 is just negative net income and available cash. So here, this positive delta apostrophe net balance sheet is in fact a bad thing for us. And that's also why in the backlink we want to reduce cash and equivalents by 60. So the idea here of the backlink is just to sum these values up from the different cases, make sure that we are in the planning horizon, and then backlink this up to the balance sheet. So the way that I do this here is just by the sum, and the reason it works is because these cases are messy and thus only ever one of these will be used, which is why I can do it like this here. Same thing, of course, for the account accounts. So let's just check out where these cash and equivalents are going up here. That is the backlink. Here you can see the backlink in the cash and equivalents from balancing, what I could put in here from balancing delta apostrophe net balance sheet, in fact. So this then drives down the 726.8 from the beginning by some 60. As you can see here, from balancing net income, we will just right get to this, but here nothing seems to happen. Let's have a sneak peek into the other side, current accounts, and here from balancing net income, you can see those minus 110. So let's see why this is the case in the next step. So we move on to the net income balancing section. And here, as you can see, this starts with net income as such. So we just get this from the income statement. Please note here that for the opening balances of the cash and equivalents and current accounts, we now need to account for what we just backlinked. So in this case, this is no longer this 726.8 because we reduced that by some 60. And now we need to start out from these 667 in this case. Nothing changed, however, for the current accounts because in the backlink, well, there was just 0. So this is why we still have those 2.2 million. Now that we have some positive net income, here those 110, while we are also having some used overdraft, here those 2.2 million, we are in case 2. And well, because of the positive net income, we can now pay back a part of the current accounts here. So this will drive these down from 2.2 million to 2.1 million. And we will just see that in a second. So here we have the backlink again. I'm summing these up, which I can do because the cases are messy. Same thing here for the current accounts. So let's see where these minus 110 and the current accounts are going. I think we just saw that. So here we have them, those minus 110. And here we have the new current accounts of some 2.1 million. So that's already it for the balancing part. We just balanced based on delta apostrophe net balance sheet first up here. And then in the second step, we balanced based on net income. Here we made sure to account for the balancing that we did in the first step in the opening balances of cash and equivalents and current accounts. And then the logic down here is really just the same. So that's already it for the balancing. So let's have a look into the special line items next. We will start with deficit not covered by equity. And as I also don't want to spare you the complexities of the beta, let's do this over there. So I went back up to the equity section in the balance sheet. And as you can see, this is really not the best case to explain this. So let me just quickly adjust the net income and turn this from positive 110 into minus 5,000. And now we have some deficit not covered by equity of some 3K. Also note here that the check just, started to complain because now the assets and liabilities and equity do not equal anymore. So the check is doing its job. Now let's move to the other side of the balance sheet because we would expect those 3K in deficit not covered by equity to show up there. And here they are, deficit not covered by equity on the other side of the balance sheet, some 3K. And here, as you can see, equity after balancing, this made sure that, as there is some deficit not covered by equity, this is cancelled out here again. So because it's just moved to the other side, we don't need it here anymore. Also, please note up here in the opening balance in the next period, I need to make sure that I get two things and sum them up. So the first thing is this equity after balancing from right here. And as it's a 0 now, I need to go to the other side and get these values with a minus 3K, multiply them with -1 because we have negative equity in fact, and for the opening balance it can and should be negative. So it's just that in the end, the final balance sheet item cannot be negative, but the starting point, so the opening balance in this case, for sure has to be negative if we are having a deficit that's not covered by equity. So before we move on to the income taxes, let me just quickly adjust this back to what it was. I think I just can do it like this. Yeah, so now the checks also don't complain anymore, and we can move on to the income statement to have a look into the taxes. And we have them right here in this line. So I think here it's easiest if I just go to the very left to explain this. As you can see, we are having an interface value that is kind of our base value, but really in the planning horizon. And that's also what we are checking here. We want to calculate these based on the earnings before taxes of the entire financial year. So what we are doing is, we're first checking if we're in the planning horizon, and then we are checking if we are in the tax month. So that's this 12, because the financial year ends just at the end of the calendar year. And if this condition is fulfilled, then we sum up the EBT across the financial year, multiply it with the tax rate, that's these 30% here in this case, multiply the whole thing with -1, because the idea is to pay taxes if you have positive EBT. And as you only pay taxes if you are making positive EBT in sum throughout the year, we need to make sure that we only populate this plan value here with a value if we are having a positive EBT. So that's this part. It's just checking that the sum is non-negative. If for some reason these conditions are not fulfilled, which is for example the case, if we are not yet in the planning horizon, then we just go with the interface value. But if we are in the planning horizon, we calculate the taxes like is shown here. Finally, let's have a look into the bank loans and interests, and also the interests for the current accounts, which we can just calculate now because they are based on the balancing. So in the Excel model, we just need to move up a little bit, and here we have the interest income and interest expenses. So let's start again here on the right with an example. We are planning this if we are on the planning horizon, and then we get cash and equivalents from the balance sheet down here. Note that I'm getting the last period's value, and the reason for that is I do not want to introduce a circular reference here. So if I got this value is 281, the problem would be that, here interest income is going into net income, which is going into equity, and equity is balanced by current accounts down here. As you can see here, from balancing and from balancing net income, especially from balancing net income in our case here. And that's why I cannot get this value. I need to go with the last period's value as a simplification, because that avoids circular reference. Other than that, we have this interest rate in here. So this is nothing special. I can just show you on the accounts tab, I'm taking the average of these two, which happen to be the same. That's this. So let's go back here. And finally, we need to divide this by 12 as the interest rates are per annum. Now for the interest expenses, it gets a bit more complex because we need to consider two things. We first need to have a look into the bank loans and their interest expenses. And then second, we need to look at the current accounts and their interest expenses and add the two. So for the bank loans, the client provided a plan, and also for the interest expenses incurred by these bank loans. So that's what we're having here in the interface line up here. And now what we need to do is to add the interest expenses incurred by the current accounts, which are in line 228. So again, here to avoid the circular reference, what we are doing is we are working with the previous month's value, and we are getting the interest rate as well from the accounts tab. So K7 in this case, I think it's 8%. Let me just go there here. So as you can see, the overdraft facility is quite expensive compared to what we get in case we have some cash in equivalents. But that's just the way it is. We need to divide by 12 as well because this is a per annum interest rate. And we need to multiply with -1 to make sure this here becomes a cost item. I just scroll down a bit into the balance sheet, and here we are looking at the bank loans now. So you will note that for the interface line here, this is just empty. And the reason for that is the client didn't plan the balance sheet. However, the client provided a separate plan of the bank loans. So these are just coming from the accounts tab. Let me just show you. So here we have them, the bank loans from the different banks as a total. And down here we also have the corresponding interest expenses that are incurred by these bank loans. So just to show a bit more how the numbers go together, let me just go to the very right here. So here for the very last month we have those interest expenses of 3.8 and we have bank loans of some 700. The 700 we just saw on the B tab. But for the 3.8, let me just quickly show you here in the input tab. So down here we have those interest expenses. And when I go to the very right, you can find those 3.8 here as well. Also here, please note that these interest expenses in the planning horizon only include interest expenses for the bank loans, so not for the current accounts. And the reason for that is simply that the client, because of the missing integration in their plan, so they only plan the income statement, they naturally cannot know the current accounts. However, as they plan the bank loans separately, they put in here the interest expenses for these bank loans. And well, the bank loans, they are not that interesting here because they are pre-planned, let's say, and they will become interesting when we look at the gap in midterm financing. But as such, technically in the integrated plan, they are not really that interesting because they are not used for balancing the balance sheet. So that's really the difference between the bank loans and the current accounts. The bank loans are there for midterm financing and the current accounts are there, well, for making sure that your balance sheet is balanced on a monthly base or, well, in the short run. Now, as a very last step, we should actually copy this B tab and also best this base plan tab, which is just an aggregation of what we just saw, so without all those interface and plan lines, to the version that we are building at the moment. So this one, but I think it's easier here to, for the next step, just go with the full version, so the final version of this, and you either keep those and put in new tabs for building those, or you just kick them out. That is if you want to build those tabs as a practical exercise. From my end, I don't think it's interesting for you to watch me build these things. So for example, the liquidity chart, I'll go into the details of what's different as opposed to the short-term liquidity version, but it's really just the same more or less technically. And for these tabs, well, this is just an aggregation with some more KPIs, so I will sure provide an explanation for that. But also here, and especially here for the measure tab, I don't think it's interesting for you to watch me build this stuff. So as usual, I'll explain the formulas. I think this here may be interesting because of the indirect. But other than that, I think we keep this rather short. And here I just skip back to the slide. So as you can see, for example, in phase 3, planning cases and preparing the reporting, we will get back to the integrated financial model anyway, and then we can make up our mind about the numbers. But here, this second work package in the first phase is really about the technicalities, so understanding the formulas, how the data flow is going through the model. So I don't think it makes sense for us to go into the content details at this point.